Secured loans are backed by collateral. Welcome to an episode of Financial Terms Explained. Today's episode will break down some complex financial concepts into simple, understandable language. Today we're exploring key terms related to credit and investment that you'll encounter when applying for loans or considering investment opportunities. Understanding these terms can help you navigate financial decisions with greater confidence. Before we dive in, I want to emphasize that nothing in this episode constitutes as financial advice. I am not a financial advisor, and the purpose of this podcast is purely educational to help you improve your financial literacy so that you can make better decisions and have more informed conversations with qualified professionals. Let's start with some important terms that you'll encounter when dealing with loans. LVR stands for loan to value ratio, and it's a crucial metric used by lenders when assessing loan applications, particularly for mortgages. Put simply, LVRs represent the amount you're borrowing compared with the value of the asset you're purchasing. It's expressed as a percentage. For example, if you're buying a property valued at $500,000 and you have a $100,000 deposit, you'll need to borrow $400,000. Your deposit is 20% of your purchase price, and your loan to value ratio would be 80%. We work out the loan to value ratio by taking the amount that you'll need to borrow divided by the property value multiplied by 100. Why does this matter? The lower your LVR, the less risky you appear to the lenders. Many lenders offer better interest rates to borrowers with lower LVRs. Additionally, if your LVR exceeds 80%, you might need to pay LMI, which stands for Lender's Mortgage Insurance. LMI protects the lender if you default on your loan. Amortisation refers to the process of gradually paying off a loan through regular repayments over time. These repayments typically include both principal, the amount that you borrowed, and interest. Early in an amortization loan, a larger portion of the repayments goes towards interest, with less reducing the principal. As you progress through your loan term, this balance shifts with more of your payments reducing the principal. Understanding amortization can help you grasp why making extra payments in the early days of your loan term can significantly reduce the total interest you'll pay over time. An offset account is a savings or transaction account linked to your loan, typically a mortgage. The balance in this account is the offset against your loan balance when calculating interest. For instance, if you have a $400,000 home loan and $50,000 in your offset account, you'll only be paying interest on $350,000. This can save you a significant amount of money over the life of the loan without losing access to your savings. Keep in mind that different financial institutions may call this facility by different names, such as mortgage offset account, interest offset account, or home loan offset account. When exploring mortgage options, be sure to specifically ask your mortgage broker or financial institution about offset facilities and how their particular version works, as features can vary between lenders. Now let's explore some key investment terms that are essential for anyone looking to grow their wealth. ROI, or return on investment, measures the profitability of an investment. It's calculated by dividing the net profit or loss of your investment by the initial cost, which is expressed by a percentage. For example, if you invested $10,000 and it grows to $12,000 after 1 year, your ROI is 20%. 12,000 minus 10,000 divided by 10,000 multiplied by 100. ROI helps you compare different investment opportunities objectively. However, remember that it doesn't account for time or risk, two crucial factors in investment decisions, which is referred to as an opportunity cost analysis. When making financial decisions, one of the most powerful tools at your disposal is an opportunity cost analysis. This simply means evaluating what you're giving up by choosing one option over another. Understanding opportunity cost helps you evaluate trade offs more effectively. For example, if you decide to pay off your mortgage early instead of investing that extra money into shares, an opportunity cost analysis would compare the interest saved on your mortgage against the potential returns from the investment. This isn't just about comparing raw numbers. It also weighs factors like risk tolerance, time frame, and your personal financial goals. The opportunity cost is the potential investment's return you might have earned by investing the money elsewhere. The beauty of this analysis is that it forces you to think beyond the immediate decision and consider a full spectrum of possibilities for your money. It shifts your mindset from, is this a good choice, to, is this the best choice available for me right now? This more comprehensive approach can reveal hidden costs or benefits that might otherwise go unnoticed in your financial planning. Albert Einstein allegedly called compound interest the eighth wonder of the world, and for good reason. Unlike simple interest, which is calculated only on the initial principal, compound interest is calculated on both the principal and the accumulated interest over time. This means your money can grow exponentially rather than linearly, especially over long time periods. For example, $10,000 invested at 5% simple interest would earn you $500 per year, reaching $15,000 after 10 years. With compound interest, it would grow to over $16,288 in that same time period without adding extra money to it. The key takeaway: starting to invest early, even with small amounts, can lead to significant growth due to the power of compounding. Diversification is essentially not putting all your eggs in one basket. It involves spreading your investment across different asset classes, industry, and geographic regions to reduce the risk. For instance, instead of investing all of your money into technology stocks, you might invest in a mix of stocks, bonds, real estate, and perhaps even commodities. The fundamental principle behind diversification is that different assets perform differently under various economic conditions. When one part of your portfolio is underperforming, another may be doing well, potentially reducing your overall volatility and risk. Yield refers to the income return on an investment, expressed as a percentage of either the current market value or the initial investment. This could be in the form of interest, dividends, or capital gains. Different types of yields include dividend yield, annual dividends per share divided by the share price; bond yields, annual interest paid divided by the bond's current price; or rental yield, annual rental income divided by the property value. Yield is particularly important for income-focused investors, such as retirees who need regular cash flow from their investments. However, it's worth noting that investments with higher yields can often come with higher risks. Let's talk about some common credit facility terms you might encounter. Secured versus unsecured loans. Secured loans are backed by collateral, an asset the lender can claim if you fail to repay the loan. Home loans and car loans are typically secured by either the property or a vehicle you're purchasing. Unsecured loans, on the other hand, aren't backed by specific collateral. Personal loans and credit cards are common examples of this. Because they pose a higher risk to the lender, unsecured loans generally come with a higher interest rate than secured loans. Fixed versus variable interest rates. A fixed interest rate remains constant throughout the loan term, providing certainty about your repayments. This can be beneficial for budgeting, but might mean missing out on market rate falls. A variable interest rate, as the name suggests, can change over time based on market conditions. While this introduces some uncertainty, it can be advantageous if rates decrease. Many loans offer split options, allowing you to fix a portion of your loan while keeping the other variable. When shopping for loans, you'll often see two rates advertised: the interest rate and the comparison rate. The comparison rate is designed to provide a more comprehensive picture of the loan's cost by including most fees and charges expressed as a percentage. This makes it easier to compare different loan products. A loan with low interest rates and but high fees might have a higher comparison rate than a loan with slightly higher interest rates and fewer fees. Understanding these financial terms doesn't just make you sound smarter at a dinner party. It empowers you to make more informed financial decisions and have more productive conversations with professionals. Remember, financial literacy is a journey, it's not a destination. Keep learning, keep asking questions, and don't be afraid to seek advice from qualified professionals when making important financial decisions. For those of you who want to continue building your financial vocabulary and put these concepts into practice, I've created two special resources for our listeners: a comprehensive financial terms glossary that expands on the concepts we've covered here today, and a financial fitness tracker. You'll find links to both of these resources in the show notes below. Thank you for listening to Financial Terms Explained. If you found this helpful, please like, share it with your friends, and subscribe. It really helps the algorithm to identify what you like and don't like. If you're new to my channel or returning for some fresh insights, welcome. I'm glad you're here. Until next time, I'm Christine. Thank you for committing to a life of freedom and abundance through financial literacy. Bye for now.